This conference will now be recorded. This conference will now be recorded.
Okay. So, good morning, Umesh, and welcome back to a fresh new session of market risk modeling. And we were talking about, and we were discussing the asset price risks, right? So, how does asset price risk happen, and how is it that it is kind of formally represented? And in an attempt to do that, we were talking about some of the key factors. So we had been talking about the Black-Scholes framework, right? So we talked about the differential equation, the crash dummy. We talked about the factors which impact the crash, and how is it that the crash takes place. What are the factors which would identify the crash? So some of the key important key points to summarize the discussions that we have had till now are as follows. Number one, first of all, what we saw was that the element of crash is a very important element as far as financial markets are concerned. The second thing that we saw over here is that it is this crash rate which determines the mean returns in a market, in an asset market. The next thing that we saw was that this crash rate is driven by the tendency of the investors to herd in the market. So the stronger the herding tendency, the higher is the mean returns, and higher are the possibilities of this to crash. So that is something that we had seen in the discussion in the last class. We had been talking about extensive examples from the U.S. markets where we had seen similar kind of patterns in asset prices repeating itself. And in different instances, be it the crash of 1987, be it the dot-com bubble, be it the housing crisis, and the type of role that the financial markets have had played at that point of time. So, from that perspective, we had seen a lot of different functions which are coming out across. Now, the next thing that we wanted to talk about over here is as follows. So, the next class, so over here, what we had been talking about was some of the factors which impacted the asset prices and which actually drive the crash rate. How is it that the asset prices fluctuate in the market? How is it that this excess demand and supply in the asset prices help us in explaining the riskiness in the assets, right? So we had talked about volatility. Also, in the last class, we talked about something called the mildly explosive processes, and how is it that these explosive processes help us identify a crash or a hindering crash going forward, right? So that's what we had discussed in the last class, and we saw that if a first order time series has uh, so if a first order time series has coefficient more than one, right? And how is it actually, and what we get to see is how is it that it is actually described and how is it actually captured. So that's where so that from there we can identify this crash rate, right? So over there, into that aspect, we had also talked about the concept of rolling samples, right? Identifying the size of the rolling sample, and how is it that as the sample rolls and you keep on estimating the autoregressive component, and you see that how is it that this row is actually changing over time. And if you see that, so whenever you see that there is an explosive tendency building in the time series, and that is gradually increasing, you'll see that that is tracked by the row. So this is something that we had talked about, but yes, there are again challenges that due to certain data changes, due to certain data issues, misspecification issues, what may happen is row may give you actually a greater than one, but that is actually not a bubble period, or it may not be a very explosive time point. So there are these challenges. So there are classification, misclassification rates. So those model needs to be validated. We'll come to them going forward. But talking as of now, so in the last class we just stopped at two important things. That so how is it that we can actually identify whether the asset prices that we have over here, or whether the asset prices are getting explosive, and whether they they are pondering towards the zone of risk, right? So once we try to understand that, once we get an idea of whether, then we'll talk about hedging the market risk, the risk. So how is it that this asset price risk can be actually hedged, right? So that's where we'll talk about them as well. So over here, so basically, before we move on, right, before we move on, so I would not be talking much about it today. So what I'll do is I'll share the recordings with you first, right? You need some time to go through it and you need to settle down on these concepts first, and then we can take it up from there. So just I'll just try to close this part on asset pricing first today, and then I'll introduce you to the next connect, and I'll leave it there for the day so that you can and allow you to go through the recordings. So over here, one very important concept or one very important part uh, is the key metrics that we generally get to see when we are talking about these asset price risks. And asset price risks are actually captured from very good macroeconomic some first from some stock market specific variables. That's, let's put it like this: asset market variables and some macroeconomic variables. It's also very interesting to see how how is it that these signal the existence of uh, of a hindering crash or a looming crash in the next few, or in a forward looking time period, right? So in the last discussion when we had, we talked about the fact that we need to also, our objective is to identify that whether a crash occurs in T plus DT period, given that it has not happened in the T8 period, right? So does the crash occur, yes or no? So if I write it like this, crash is yes or no. So over here, what we try to do is, our objective is to understand whether there is a domain crash or not, and how do we identify that? So obviously, one way of identifying it is the price earnings ratio. That's one. The second is the market capitalization to GDP ratio. So the next thing, so another very important part is the dividend stream. So the next factor that we need to talk about over here, as far as asset price risk, asset market risk or asset price risk is concerned, so another very important factor would be the dividends. So how is it that you identify, so how is it that I can identify a looming crash from these dividends? From these three, let's say from these three variables. So there are other variables which talks about the fundamentals of the asset. You have other ratios like price to sales ratio and so on. So, but looking into these three ratios, how is it possible that I can find out that whether a particular stock market is so whether is there a crash looming in the time T plus DD period, given that till the T8 period the crash is not actually occurred, right? So that's what we are trying to understand in our discussion today. So when I talk about, so let's first try to understand each of these concepts, right? So obviously when I talk about dividends, you are very well aware what dividends are. So dividend is a part of the capital distributed by the company to the equity holders or to the stakeholders, right? So this is a capital distributed by the company to the shareholders. And this is done when the company earns profit. So capital distributed to stakeholders. Capital distributed to stakeholders, or let's say the equity holders, uh, by the company, by the company. Now the question that comes out is, then where is it that the company pays the dividends from? Right. So the next question that comes out over here is, so the next part that we have over here is that how is it or where is it that the company gains it or where is it from where they pay the retained earnings or the pay this. So they pay it from the retained earnings. So the company decides to give this to the stakeholders from their retained earnings, right? Now, once they decide that so basically, if a company is paying a dividend annually to its stakeholders, what it means is it is making substantial profits so that it can pay the returns to the stakeholders, right? So that is something that they are actually doing over there. Now, the next question that comes out over here is that what does this signal? So what it signals is that if your company is actually paying you dividends on a regular basis, right, at a certain rate, and where the dividend is growing at a fixed rate, then means that the company is fundamentally stable. Mentally stable. Now, this is where there is another. So this is an interesting catch over here. That this part that the company pays as dividends, right? So let's say it's a bank, right? Let's say it's Goldman Sachs. So Goldman Sachs always plays, or say, let's say it's Morgan Stanley. So they have their equity holders, right? And they have to pay their equity holders a certain amount of dividends. Now, so that forms a part of their capital distribution plan. Now, let's say that they have not been able to keep back substantial amount of capital, right, and they do not pass the CCAR test, right? So CCAR does not approve them. So when that happens, so the moment CCAR rejects them, it does not pass the CCAR test. That's where it means that the company was willing to pay out something as dividend as a part of its capital distribution plan, but given the fact that they do not have a sufficient amount of capital, right, the regulators feel that to survive during downturns, if something comes in, then they would not have substantial amount of capital kept over there, and hence they reject their dividend policy. Now, if they cannot pay out that dividend as they have promised to the stakeholders previously, or so if that dividend cannot be given, what it essentially means is so that raises a question mark on the existing credibility of the company, because everyone understands that the bank does not have sufficient amount of capital to survive a downturn in terms of severely adverse and baseline cases. So in that part, what we need to understand is we need to know that okay, this is how this particular part will be done. So this is how it is being created. So over here, what we are trying to understand is that how is it that this T plus. So how is it that this uh, dividend is an indicator of a crash. Now, let's say there is a price of a stock, right? So, an asset price, which is growing at an impeccable speed, but there is no dividend which is being paid out, right? Now, so one possibility in this that this company, the company like Apple, right? So there was a phase when Apple was not paying out any dividends because they did not want to let the cash out. But when they did pay their dividend over a period of year, they paid it at 170% or something like that. So it was more than 100% dividend which they had paid to their stakeholders, because once assets, Apple's sales had increased and the cash flows had come in and they were stuck with cash, they decided to just pay the dividends to the market and send out a strong signal that yes, as Apple is doing like hell, uh, hell would, and therefore it can pay more than 100% dividend to its stakeholders, right? So dividend, therefore, is a very important signaling factor. So we're looking into the dividend payment structure patterns, right? So we can actually identify whether a particular asset price is, or how likely is it that this asset price or this company is going to crash in the future and so on. So dividends will be a very important part, because if I compare the price, the asset price series to the dividend series, and I see that the dividend series is stationary, or the dividend series is not impacted by too much of temporary movements, but the asset price series is, then you would know that there is a possibility that the fundamentals of the company is not justifying the price increase, and hence it is very possible, it looks very likely that it may crash going in the next D plus DT periods, right? So dividends is a very critical part in assessing or in trying to predict whether a stock market or an asset price would crash or not, right? So that's one part of the story. Now the second part of the story is your price earnings ratio. So if I talk about the so price earnings ratio. Now, price earning ratio is a very famous ratio. It's one of the most traditional, one of the most classical ratios. And this price earnings ratio does give us very in-depth, or it gives us a very quick insight asset price. Because when I talk about asset price earnings from a stock is the share that you make from a stock, right? So now you see that the earnings of your company is growing at a certain rate, but the asset price is moving up faster and faster. So what does that mean? What it essentially means is that price earnings in a price earning ratio, so it's a ratio at the end of the day, right? You have the price, you have the earnings, and the price earnings is the simple ratio. Now, if I'm talking about this particular ratio, and I see that the price is increasing much faster than the earnings. Now, what is this earnings? This earnings is the earnings of the firm, of the company for whose share the price is increasing. So, if I see that if the price is increasing more than the earnings, yeah, so there is obviously a certain limit, right? So let's see, I see that the prices earnings are doubling, whereas the prices are like 10 times where going, right? So for every doubling in the price earnings, the prices increase tenfolds, 20 folds like this. So so over here, what happens is that so over here, what we get to see is that this increase in the price earnings ratio gives us again a true indication of the stock prices to crash. Like what they say is that if it's a lingering crash, and let's say it crashes, so following a crash, the price earnings ratio undergoes a thorough structural break. Now, when once this break happens, you know that a market correction or some kind of a change is happening. So if this ratio is very high, let's say 60, 70 times. So let's say the price is 130 times the earnings. So you know that the earnings of the fundamental of the company is not justifying the price increases. It means that there is a huge element of speculation which is around that, which may cause the asset prices to crash, right? So this is a very important part, or so this market is, or this source of asset price market risk is a very important source. Now, the third variable that I have to talk about over here is the market capitalization to the GDP. Now, when I talk about the market capitalization is nothing but the price per unit of the share into the total amount of shares outstanding. So how do we define the market? So shares outstanding? Shares outstanding refers to the shares which is there with the people, out there with the people in the market, right? So if you see that the market capitalization is increasing, you know that. So basically what happens is the number of shares would not change much, because until unless there is a fresh IPO. So an increase in the market capitalization purely implies that the price of the shares have gone up, right? Now, if the market capitalization is increasing at a much faster rate, right? Let's say the market capitalization is 80 times the GDP, the change in the GDP. So what it means, what it precisely means is that it's the financial markets, right, where the capitalization is going up. So all the things or whatever is increasing, the wealth that is generated is increasing in the stock markets, but that is not flowing back into the real sector, into the production sector in the economy. So that benefit is not percolating to the economy. But if that is not happening, you know that whatever increase is going on over there is a kind of speculation driven. It's a kind of bubble which is growing up in the stock markets, and one small far fund reversal, your entire markets collapse. So this was a similar criteria, a similar feature which was seen in 1997 uh, South Asian crisis, right? So stock market crisis, where once the funds started reversing, so it took down everything, right? So the entire economy went into recession because the entire growth in the economy came from these funds, from investing these hot money, or investing these quick money, quick shares. So basically, when the funds started reversing because of changes in interest rates or changes in returns, the entire market went down, collapsed. So the South Asian crisis was a typical example of this type. So over here, whenever we are looking into these these ratios, the movements in these ratios can give us very important insights into the nature of the asset price movements, right? So basically, so these are three important variables, right? So let's try to look into one such variable. Let me try to talk about the dividends, right? So the dividends that are given at a given date, right? So so basically, what we need to do is we need to assess the fundamentals of a firm, right? And I want first of all, in order to understand whether the stock prices will crash or not for a firm, what we need to understand is that how strong is the firm fundamentally? What are the fundamentals of the firm? And one type of a fundamental definition for a fundamental of the firm is defined in terms of dividends. However, this definition has very limited approach in today's world, given the way that the financing has totally changed in this new business setup. But we'll stick to the very basic definition of this, So we'll stick to the very basic definition of a fundamental of a firm, right? And we try to understand that given the fundamentals, right? If the firm is so what is the fundamental value that the share should have? But if it has something more than that, that's where a challenge is. So higher that increase, the deviation that happens between the fundamental price of the asset of that share and the actual market value, the greater the difference will be, the more would be the chances of the asset prices to crash, right? So we'll explore this particular channel first, and from there we will take up the other factors that we talked about. Okay. So let's talk about dividends. Let's try to understand how dividends would give us an idea about the fundamental value, and how is it that the price above the fundamental value will be. So as the difference increases, how is it that we can say that it is gradually nearing a crash, right? So we had talked about all these previously. Now we just try to put things together, right? Okay. Now, what happens is that when we talk about dividends, so when we talk about dividends, uh, dividends are so basically we don't just look into dividend that is the firm is paying only once. I'm looking into the future stream of dividends that the firm would actually pay, right? So that's what we need to Understand. So basically, how much or what is that stream of dividends that I would keep on getting over a period of time? So let's start. Now, what is dividends? So, as we all know, so basically, when a firm or when transport company starts its business, it raises money from the market, right? So, what it does is it divides its entire capital into different among different people and issues a paper, right? The paper says that okay, you give me this kth fraction of my capital to start up, I'll do the business and I'll give you the returns within this time, or at least this much of return during this time. So over here, when we talk about like this, so what we need to understand is that okay, how likely for me is it to get the return, right? So that's something that we need to understand. So basically what happens is that when a company starts its business, when a business initiates, so the company issues a share, right? So there is a company, and what they do is they issue the shares. Okay. So now what the company does is the company issues these shares, right? And each share, say, is of $10. So each share is of $10. Now, what they do is, so basically, the next thing that happens over here is that the company says that okay, you give me $10 now. When I earn the money, I'll give you say 3% dividend on this. So out of 10, right? So if I'm getting three, so what I'm getting is 30 cents per uh, $10 invested, right? So now if I invest like say 20,000 stocks of this particular company, so then when going forward, I can be a huge, so I can be a huge money. And even when it goes out, so when I earn that money, I can actually buy the stocks and I can make more money out of it going forward. So, so the profit that I'm giving to the stakeholders, that's the dividend, right? And the dividend has a given rate, right? So let's say I have invested around 30,000, or say, yeah, so 30,000 in the total shares of that particular guy. Now, when I have sold them, so when I have got like 30 shares, right? And so basically what I know over here is that this company will actually give me some dividend at the end of the year. So there would be a whole set of stream of dividends, right? So what I want to know is that if the company keeps on giving me this for the next 10, 12 years, right? So at the end of 12 years, I'll get a stream of dividends. So I'll get a money value. Now, what if I want to discount it back at today's date? So basically, what if they wanted to find out an equivalent of that stream or the value of the stream in today's pricing? So what will be that price if I need to actually give it to you to learn? So so basically, so when I'm giving you this dividend, right? So I want to know that okay, fine, I'll get a stream of dividends, but if what would be the equivalent value of that industry standing in today's date, right? So that is where the concept of net present value actually comes in, and we say that if that ideally, right, the increases in the stock prices should be lower than the average increase in the average increase in the dividends, in the dividend stream. So basically what you would see that if I had a so basically if I had a company and I would distribute my shares and everyone would buy it, and from there I would get the capital to work with it. But again, what I need to do is I need to go down to them, and I need to, so when I want to sell off my holding, right? So I want to sell it to someone else. So basically what happens is you so basically, why do I want to move out from here? I would only move out if the net present value, so the net present value in the stream of dividends today is more than the rising prices. So then only, so basically compare the, you know, the gain that I'm making from there, waiting for them to go bad, waiting for the collection, so on. If I get the equivalent amount today's date, I would be better. So I need to know that net present value, because it is that net present value which will give me an overall working idea about uh, the probability of the borrower or the asset to crash, right? So basically, what I want to know is that I want to know that, okay, what is the equivalent value of that dividend stream over 20 years? What is the equivalent value standing today, right? So that's where this role of this dividends come in. And when we see that the asset prices, so if the asset price path is more or less symmetric in nature, any further symmetricity. So basically, so yeah. So basically, if we see that if the asset prices are increasing much more than the change in the dividend, then you know that there is a problem. So this is where this role of dividends actually come in. Now, so the next part, so we had already extensively talked about price earnings, and we had talked about market capitalization to GDP ratio, right? So the only question that I have to ask you is that, is this part whichever I described about the, you know, so about this portion on market risk today. So are you like kind of clear with this part? So any questions from this?
No, I'm good so far.
Great. Okay. So just give me a minute, Umesh. I'll just come back and we'll get started. Okay. So so let's graphically have a quick look into how this may happen. Now the point is that if I look into the dividends, right, the path of dividends do not change overnight. Right? So it takes time for these things to happen. However, if I see that the asset prices are increasing very fast, you know that, or rather, let me put it like this: that they are increasing exponentially. there you know that yes, this is a particular part where these asset prices are, so where it is being driven by something which is not your fundamentals, right? And that's where we typically say that the asset price is very likely to crash, or the crash hazard for this asset price would be very high, or typically, as we say, the asset price is in a bubble. So over here, I'll put the time factor, and this is the asset price. Right. So let's start looking into this. Let's say this is how the dividends path will go ahead. There is nothing much more to go, right? So basically, if I assume that this dividend price is more or less growing, right, over a period of time, so or let's say it can so happen that a similar or an increasing trend in the dividend is observed in the long run. Over a long period of time, you see that the dividend is increasing. Now, let's consider this asset price movement. So now, when you look into this asset price movement, you see that the increase or the movement in the asset price is very similar to the movement in the dividend. So when I'm looking at the long run asset price movement, right? But but so this is case one. So this is a case where, on the whole, when the market is increasing in terms of its value, right, the fundamental of the terms of income is increasing, the asset price is also increasing, and more or less it trades between a certain interval, right? So that is case one, right? So, so fundamentally moving asset prices. So this asset price is moving down fundamental. Okay, so this is fundamental asset price growth. Now, on the other hand, what we get to see is that, so over here, this is what I can say is the fundamental asset price growth, right? And what we can say is that more or less these two systems are stationary, right? So they are not very explosive in nature. Now, what you get to see is another asset price. So over here, what you can see is that the difference between the dividend process and the asset price is subsequently and is continuously increasing between the index price and the asset price, the dividend part. Now, in this case, right? So in this case, so let's just put. So this is the dividend path. So this is the dividend path. Now what I can see over here is that the increase between the dividend path and between the asset price path is increasing continuously, and it is increasing at a very at a very increasing rate. And when you see that when it is increasing at an increasing rate, what you can clearly say is, what you can clearly kind of make out is that this movement or this increase is exponential in nature, right? So what it does is essentially over here is it so it has increased the gap between the two. So, and this is because of speculation. And when this gap keeps on increasing, right, this the speculation, or as we call it, the irrational exuberance in this asset price or amongst the decision maker, is something which causes this asset price to diverge more from its dividend path, and then it just hits back, it just collapses after a point of time. So the greater the difference is, so the greater the difference is, higher are the chances of the crash, right? And this increasing, subsequent increasing deviation of the asset price from its fundamental value would clearly mean, or would indicate that yes, this is or this asset price has a bubble building inside it, and this is one of the most this is, how should I put it, so this is one of the most critical asset price risk that we get to see, right? So higher chances of crash. Clear?
Yep.
Okay, fine. Okay, okay, fine. So just go through this. Just give me a minute and I'll just be back. I just have a call coming from work. Just have a call coming from work. Just give me a minute. Okay, so so having said that, so having said that, now the next question that we want to understand is that uh, so if I have the risk, so if I have a risk in the asset markets, right? So how is it that we can hedge that? What are the different kinds of hedging instruments that we'll have it, and how is it that we can estimate the risk, right? So talking about the risk estimate, or estimating or predicting the risks in the stock market, so that's where we have these asset price, so we have these statistical models of time series, and we have the statistical models of not only time series, but we have all the new machine learning models and everything. So we'll come to them gradually. So so after this part, the next thing that we want to understand is that what are the ways through which I can actually hedge the risk that I have in the asset market. Now, see, one way to hedge the risk is very simple, right? So if you see that the asset market is, or a market is becoming very volatile, right? So that's where you invest in some other assets. So you invest in an asset like a gold. So what you are doing is you are kind of diversifying the risk. So you are not actually keeping your asset in one single, or you're not keeping your finances into one single bucket, but what you're doing, you're just diversifying it over a period of time. So that's one. Now the question that comes out is, how do I assess that the market is becoming risky? So how do I assess the riskiness in the market? What are the measures of doing that? So those measures, the measures of identifying the riskiness in a market, is, or in an asset price market, is done by, or can be captured through the volatility. Through the volatility, and the volatility of asset prices. So volatility of asset prices. Okay, but before I go into that asset pricing part, right? So just one quick observation. So I talked about the dividend part, right? So just one quick observation on the price earning. Now, generally, what happens is that if your asset prices are being driven by the stock market movement, so if you see that your asset price is being moved very much by speculation, and you have a price, and there is a price earnings ratio. So and ratio is very high. You know that one very important characteristic that the market undergo a correction, right? And price of the asset crashes, the price earnings ratio would undergo a structural break, right? So something like this would be observed over here for the price earnings ratios. So if you have an asset, let's say this is a, so over here I have the asset prices over time. And what we have over here is the asset price. So let's say this is how the price earnings ratio was. And then suddenly what you see is that there is a break and the asset prices fall, and then this is how the asset, the P by E ratio becomes, right? So basically, so this is where a break in the P by E ratio is observed. A break is observed. Right, and this break, so basically, if you see that, let's so how do you identify whether a crash is booming? What you do is one thing you can do is you can look into the asset prices, the price earnings ratio the market has provided over a long period of time, right? And over there you will see certain spikes have occurred, right? Then the idea is that, okay, let's say if it was a war period, or if there was some special periods, then the price earnings ratio would be very high, right, in that time. So what you need to do is you just need to adjust for those periods. So you adjust for those periods, and you kind of improve them with the average behavior, and then now you take up the most recent price earnings ratio. You try to see how is it that these two relative trends compare. Right now, if I see that my asset price ratio now is higher and it's going up, like it's much above what my average has been, then I know that in the nearby, somewhere nearby, right, a crash is looming. Let's say this is where my average generally lies. Let's say this is my average price earnings ratio. Now I see that this is, or this particular part is moving something like this. So what I see is that this is growing, going up and up. The deviation is from the average trend, it's increasing, and then suddenly it falls. Now when this happens, the break is observed. So this is where your asset price movements becomes important. So this is where your price earnings ratio becomes important. And once it has undergone a structural break, right, you know that the crash has actually happened. So, and not only that, it go undergo the structural break, but it does not recover for a long period of time, and it takes a very long period for it to come back to its average level. And the price earnings ratio may be even below the average for a long period of time. So this is how the price earnings ratio would impact the overall behavior. And by looking into the price earnings ratio, you can try and identify a possible looming crash. Now, apart from this, so these are some of the basic, kind of variables that we have, we can actually use to spot a crash in the market, crash in the asset prices, or the asset price risk, as we call it, right? But the true riskiness is captured through the volatility patterns in the asset prices. So this is the part that we next need to talk about, right? And this is where we talk about models of conditional heteroscedasticity. So I'll be talking about asset volatility of asset prices, how to capture them, and this is after this we'll be talking about the concept of value at risk. So we'll look into the concept of returns, we'll look into volatility of returns and value at risk, and how is it that these three correlate together, and that is what would be the next set of discussions, right? So let's do something, Umesh. Let's pause here for the day. I'll not go ahead. I'll share first. What I'm doing today is I'm sharing the recordings with you, right? You take today and you take tomorrow, right? So you don't need to do the class tomorrow. You just go through these recordings and find out where are your queries coming out, right? After that, next week we'll sit down with the queries, and from there we'll take it up,
Okay.
because you need to have an understanding of these. Otherwise it would be a bit challenging going forward, because now it's going to get more, because as I talk about VAR, I start talking about the other assets and volatility smiles and everything, so things will start getting more complicated. So let's first finish this part, right? So we have done quite a bit of it. So just go through the recordings, get the concepts, and then we'll just put it through.
Okay. Sounds good.
Yeah. So let's stop here for the day. Have a great weekend. Your weekend is
Yep.
starting. Ours half is done.
Yep.
We are done
Okay.
halfway through. Yeah. So let's do this and then let's catch up.
And you're
Bye.
sending it now, right? The recording.
Yeah. Yeah. So
Okay.
this recording, I'll take some time to share like a couple of hours. But the other the recordings of the last two classes, I'm doing it right now. Right away.
Okay. All right. Thank you.
Yeah. Okay.